If you go to Google and type crypto crime, chances are that the first result that comes up is a recent crypto crime report by blockchain analytics company Chainalysis. Now, this is very different from the results you would have got even just a few months ago. That's simply because the facts about crypto crime are coming to the fore, and they can't be ignored. Today, I'm going to tell you a bit about Chainalysis, break down its recent crypto crime report, and explain what it could mean for the crypto market. Before we get shady, you need to know something about me. Financial advice is not what it says on my degree. Educator and entertainer are the only things I can be. Please contact a financial advisor if your portfolio looks like a pile of debris. If this is the first time we tango, my name is Guy and I am a crypto commando. My mission is to create high-quality content about crypto, coins, tokens, news, reviews, and other valuable info. If you're on a crypto mission of your own, subscribe to the channel and ping that notification bell because it's dangerous to go alone. If you're racing against the clock, you can skip ahead by using those time slots. Just bear in mind that watching the whole way through will bring you one step closer to becoming a crypto prof. Now that I've protected myself from the cops, let's see what Chainalysis found and why it could cause crypto to take off. If you've never heard of Chainalysis before, you are in for a rude awakening. That's because Chainalysis is tracking every single one of your crypto transactions. This is part and parcel of being a blockchain analytics company, and Chainalysis is the largest one by a wide margin. It should come as no surprise then that Chainalysis isn't exactly the most popular crypto company around, especially since it works closely with government agencies. If you watched my video about blockchain analytics companies though, you'll know that Chainalysis is surprisingly pro-crypto. The company has a history of pushing back against overreaching crypto regulations and recently added BTC to its corporate balance sheet. Not only that, but Chainalysis seems to have a say in crypto regulations in the United States, and its co-founder, Jonathan Levin, has even testified in front of US politicians. Chainalysis's endgame is to make individuals and institutions comfortable with crypto, and it does this by extensively analyzing transactions taking place on public cryptocurrency blockchains. In addition to providing a series of on-chain tools, Chainalysis regularly publishes research that often debunks the ridiculous claims about crypto crime you hear from select mainstream media outlets. Every year, Chainalysis publishes a detailed report about crypto crime, which includes facts and stats about everything from ransomware to darknet marketplaces. As you might have guessed, the Chainalysis report I'll be covering today is its crypto crime report for 2022, which is actually about crypto crime in 2021. I suspect this is for SEO purposes, which would explain why it appears at the top of every Google search for crypto crime, regardless of the device I use. Excuse my nerdiness. The Chainalysis Crypto Crime Report for 2022 was released in February this year, but I reckon the findings will be relevant for the coming year as it's the crime trends that are important here. The report is a whopping 140 pages long, and I'll give you my thoughts as we go along. Note that you can find a link to the full report in the description, but be aware that you'll have to enter some personal details to download it. Blockchain analytics companies, am I right? Huh? Anyways, let's dig in. The Chainalysis report begins with a brief introduction that gives a general overview of crypto crime. The title says it all. Quote, "Illicit transaction activity reaches all-time high in value, but all-time low in share of all cryptocurrency activity." Specifically, the dollar value of crypto crime almost doubled in 2021 compared to the previous year to over $14 billion. But as a percentage, crypto crime accounted for just 0.15% of all crypto transactions during that time. More importantly, the percentage of crypto transactions associated with crypto crime has been on a sharp decline since 2017, and though 2019 is a bit of an anomaly, the downward trend is as clear as day. The authors do add an important caveat, however, and that's that the 2021 percentage could increase as more transactions from that time are discovered to be associated with illicit activity. This reminds me of a concern I have about crypto transaction tracking in general, and that's whether certain transactions could be considered criminal after the fact, even if they weren't criminal at the time. This is especially relevant when it comes to the recent sanctions we've seen against Russia in response to its invasion of Ukraine. I digress. Not surprisingly, most of the crypto crime we saw in 2021 involved a theft of some kind, and most of this theft involved DeFi protocols. In total, over $3.2 billion of crypto was stolen last year, a more than 5x increase compared with 2020. The authors explain that most of these thefts are related to errors in the code of the smart contracts that make up decentralized finance protocols, and I reckon some would argue that these exploits are not necessarily criminal, on the grounds that code is law. In other words, it's the developer's fault. Now, another unsurprising finding was that DeFi protocols were used for a lot of money laundering last year, and the total value of illicit funds sent to DeFi protocols grew by almost 20x compared with 2020. Chainalysis estimates that crypto wallets associated with illicit activity hold around $10 billion in cryptocurrency, which isn't all that much given crypto's market cap is around $2 trillion. What I'm wondering is whether this figure includes any stolen NFTs, because we've seen some shady activity happening in those markets as well. More about that in the description. Anyhow, the first part of the Chainalysis report relates to money laundering in cryptocurrency. Chainalysis estimates that around $8.6 billion worth of crypto was laundered last year. DeFi's role in this criminal niche has increased, but a handful of unregulated crypto exchanges still play a central role in this underground ecosystem. Although this represents a 30% increase compared with the year before, the authors underscore the fact that crypto money laundering accounts for less than 0.5% of crypto's total transaction volume. By contrast, around 5% of all fiat transactions are related to money laundering. That's literally 100 times more than the percentage of money laundering you see in cryptocurrency. Chainalysis also found that crypto money launderers tend to send regular crypto transfers worth slightly less than $1,000. This is because of the infamous travel rule, which requires all centralized entities working in cryptocurrency to report transactions worth $1,000 or more to the appropriate authorities. Chainalysis therefore advises any regulatory-orientated readers to pay extra attention to these kinds of transactions. Interestingly, Chainalysis found that over 50% of laundered cryptocurrency finds its way to the same 600 or so wallet addresses. These are, of course, deposit addresses at various centralized exchanges. What's even crazier is that a group of 45 deposit addresses received almost a quarter of all laundered cryptocurrency in 2021. According to the authors, this peculiar concentration of crypto money laundering is on the decline, suggesting that more money launderers are entering the industry. If any money launderers are watching, please leave. The second part of the Chainalysis report relates to criminal balances, i.e., how much cryptocurrency crypto wallets associated with illicit activity are holding. Oddly enough, the authors start by saying that criminal crypto whales hold over $25 billion of cryptocurrency, which is more than double the statistic they mentioned earlier. In any case, one interesting finding in this area is that criminals are holding crypto for much shorter periods of time than they used to prior to cashing out. How long criminals hold crypto depends on their trade, but as you can see, there has been a huge decrease across the board. The authors implied that this is simply because of companies like Chainalysis, whose tools have become more sophisticated and readily available to law enforcement agencies around the world. This means the moment a criminal cops some crypto, they know they must cash out quick before their wallet is identified, because if they wait too long, then it might be close to impossible to realize their ill-gotten gains. Next, the authors finally explain why there's such a big discrepancy between the $25 billion and $10 billion statistic. And that's basically because they count all of the crypto held by crypto criminal whales as counting towards this figure, and not just the crypto they know to be associated with illicit activity. The good news is that there aren't actually that many criminal crypto whales out there. Chainalysis estimates that there are only around 4,000 crypto criminal whales, and they only account for 3.7% of all the people engaging in illicit activity with cryptocurrency. This begs the question of why Chainalysis is so focused on criminal crypto whales in this section, and I suspect it might have something to do with the fact that the total value of cryptocurrency that can be confiscated from them by law enforcement is much larger than the average crypto criminal. This not only looks good for the law enforcement agency that seized the assets, but it also benefits the institutional investors who can later buy this cryptocurrency at auction, often at a discount. This is actually how a few crypto billionaires attained their billionaire status, and you can learn more about that by using the link in the description. Anywho, the third part of the Chainalysis report relates to NFTs and crime, and most of what they covered was mentioned in my aforementioned video about the topic, so I'll keep it short for the sake of time. First, there's wash trading, which in the NFT space involves minting an NFT and buying it from other crypto wallet addresses that you own to give the illusion that the NFT you minted has value due to its trading history. This insane image here is the most prolific wash trader that Chainalysis could find. This chap or chapette did 830 NFT wash trades in total, and all the dots you see are other crypto wallet addresses they control. Funnily enough, when you account for all the ETH they paid for transaction fees, this NFT wash trader actually lost over $8,000. Serves them right. It's a similar story for other NFT wash traders, though the authors note that there was a small group of NFT wash traders that managed to make massive profits, so much so that they offset the losses of the other NFT wash traders and gives their group a net positive return. The devil is truly in the detail. The authors also note that while NFT wash trading technically isn't illegal, they expect that regulators will soon start cracking down on centralized NFT marketplaces like OpenSea and force them to collect KYC from any wallets interacting with their platform. I understand the reasoning, but I'd rather not. Now, as far as money laundering goes, Chainalysis found that only a few $1 million was laundered using NFTs last year. But if you watch my video about that, you'll know that I'm a bit skeptical of this statistic for reasons that I won't get into here. Moving on. The fourth part of the Chainalysis report relates to ransomware, which has been a hot topic in the mainstream media. This part starts with some interesting speculation from the authors, and that's that companies which fall victim to ransomware attacks are often reluctant to report that they've been affected. This is partially because it makes for very bad press, but also because lots of the ransomware attacks come from countries such as North Korea that are sanctioned by the United States and its allies, and that means it's technically illegal for companies to pay the crypto ransom in these cases. As such, the authors emphasize that the $600 million of ransomware revenue they identified last year is probably much higher, as is the ransomware revenue from the years prior. What's shocking is that there has been a rapid rise in ransomware strains, i.e. ransomware programs, springing up around the internet over the last decade. As the authors point out, most ransomware attacks don't always come from the groups you read about in the headlines. More often than not, these ransomware groups will sell their software to individual ransomware attackers in the same way Microsoft sells software to regular folks. The main difference is that ransomware groups get a cut of any crypto received in ransom as commission. This was the case with the famous Colonial Pipeline hack last year, and it's probably why the BTC that was paid as part of the ransom was eventually recovered. The ransomware attacker was probably an amateur. It's possible he wasn't a ransomware attacker at all, but let's not go there. Now, as you might expect, the average value of the ransomware payment demanded has increased significantly over the years, so I guess inflation is affecting criminals too. Sorry, bad joke. Now, as the authors note, the increasing price of ransomware payments is primarily because hackers have turned their focus to larger institutions that are willing to pay a higher price. Once ransomware attackers have received their payment, they tend to direct their crypto to centralized exchanges. Almost half of this crypto goes to, quote, mainstream exchanges and exchanges with more established compliance programs. It's almost as if all these financial regulations don't do anything at all. Ironically enough, the authors seem to be happy with this result because it means all law enforcement must do is crack down on the handful of exchanges that are being used to cash out ransomware payments, at least in theory. The authors also highlight the fact that the explosion of ransomware strains has mostly to do with existing ransomware groups pretending to shut down and then relaunching under a different brand. The authors attribute this to sanctions. By rebranding, ransomware groups are more likely to receive payment because they can claim that they're based in a jurisdiction that isn't on a sanctions list. Unfortunately, this tactic seems to have worked, and one of the largest ransomware groups managed to significantly increase its revenue in 2020 and 2021. Note, most of this revenue comes from the cut it takes from the individual ransomware attackers who are using its software. As many of you will know, many ransomware groups are believed to be based in Russia, but Chainalysis found that most ransomware strains are actually coming from Iran. Moreover, many ransomware attacks are less about profit and more about disruption for political purposes. Now, this part of the report ends with a prediction of sorts, and that's that Monero could soon become the cryptocurrency of choice for ransomware attacks due to the privacy it offers. For the time being, however, Bitcoin remains the crypto of preference for ransomware criminals. The fifth part of the Chainalysis report relates to malware. You know, those sketchy emails that you get from time to time that obviously didn't come from your bank. The kinds of emails that some noobish Bored Ape Yacht Club NFT holders seem to keep clicking on for some reason. Besides being designed to steal your crypto, malware is also often designed to do stuff like steal your personal information, copy whatever you have on your computer's clipboard, and use your computer to mine cryptocurrency. Now, as widespread as crypto-related malware is, Chainalysis's findings suggest that most people aren't falling for it. There were only about 5,500 confirmed malware attacks last year, which is about the same as the year before. The most profitable type of malware appears to be related to crypto mining, with most crypto mining malware being used to mine Monero's XMR, since it's one of the only cryptos that can still be mined with a regular computer. The authors estimate that as much as 5% of Monero's total hash rate is coming from malware, which accounts for around $100 million of annual revenue, the largest slice of the malware pie by a wide margin. As expected, most malware operators send their spoils to well-known centralized exchanges, though this trend is declining and decentralized exchanges are starting to eat into the market share, so to speak, of their centralized competitors. The authors also explain that finding out just how much money is being made from crypto malware is extremely difficult to estimate because of how accessible it is. They then go through a case study about a malware called HackerBoss, which actually targeted people who were looking to download malware for their own nefarious purposes. Props to that guy or girl. If that wasn't crazy enough, the authors detail another popular crypto malware called Glupteba that essentially does everything malware-related, mine crypto, take info, etc. What makes Glupteba crazy is that the group behind the malware designed it so that it references the Bitcoin blockchain for instructions on how to operate whenever a website required for the malware's operations is taken down. I really suggest reading this case study if you have the time. It's on page 65. Now, this insane design means the Glupteba malware is practically impossible to eliminate, and the authors use it as an example of why every company that could fall prey to malware needs to be familiar with the ins and outs of cryptocurrency. Naturally, they say Chainalysis is ready to help with this crypto training. On that note, if you want to brush up on your crypto basics or help explain its complex tech in a simple way to a friend or family member, you can refer to my video about crypto for beginners using the link in the description. Now, back to the report. The sixth part of the Chainalysis report relates to the source of the spiciest crypto headlines, and that's stolen cryptocurrency. As mentioned earlier, Chainalysis estimates that over $3 billion of crypto was stolen last year, most of which came from DeFi protocols. The authors note that this is the first year that the crypto stolen from DeFi protocols was worth more than the crypto stolen from centralized exchanges, and it probably won't be the last. As I suspected, the authors seem to count flash loans as amounting to a criminal act, which is a bit silly considering that these so-called flash loan attacks are just extremely lucrative arbitrage trades made possible by pricing issues arising from unreliable oracles. I suppose it's somewhat irrelevant given that most cryptocurrency is stolen through code exploits and security breaches. Note that a significant chunk of crypto stolen is attributed to an unknown source too. The picture looks a bit different when the authors drill down into DeFi-specific crypto theft, however, and here's where you can see how big of a role flash loans played, particularly in 2020. To be fair, the authors acknowledge that all the so-called crypto theft resulting from flash loans and code exploits can be easily addressed by thorough code audits and by leveraging reliable price oracles such as Chainlink. Now, if you keep up with my weekly crypto reviews, you'll know that Axie Infinity's Ronin sidechain recently suffered a hack that saw over $600 million of crypto lost. Solana's wormhole bridge to Ethereum was also hacked for over $300 million earlier this year, and when you combine that with Ethereum founder Vitalik Buterin's own skepticism over cross-chain bridges, you'd be forgiven for believing that cross-chain bridges are where most crypto theft is happening. According to Chainalysis, however, decentralized lending and borrowing protocols actually saw the largest losses in 2021, with cross-chain bridges coming in second place. It looks like this order might rearrange, however, because the total value of crypto stolen from lending and borrowing protocols last year was only around $920 million, and the combined value of the Ronin and wormhole hacks alone already exceed this figure. And speaking of big numbers, the authors give a list of the largest crypto hacks in 2021, and I'll give you the top 3. The Poly Network Cross-Chain DeFi Hub, $613 million. The Bitmart Cryptocurrency Exchange, $200 million. And the Badger DAO DeFi Protocol, $150 million. What's interesting is that the authors include 2 undisclosed crypto thefts from an unnamed DeFi protocol and an unnamed centralized exchange, each for roughly $91 million worth of crypto. I wonder who those were. What's nice is that the authors close with a comment saying Chainalysis is happy to help track down any funds stolen from DeFi protocols, and they don't call for any unreasonable crypto regulations for this niche. The 7th part of the Chainalysis report relates to one of the things I talked about in my recent video about the most annoying things in crypto, and that's scams. Chainalysis estimates that over $7.7 billion in crypto was lost to scams in 2021, and a substantial chunk of these scams involved rug pulls. Why am I not surprised? Interestingly, there appear to have been fewer scam victims in 2021 compared to the year before, despite a huge increase in the amount of crypto scammed. Logically, this means the few people who did get scammed put in much more money than in previous years. What's even more interesting is that almost all the crypto that was scammed last year was cashed out using popular centralized exchanges, and they're becoming an ever more popular cash-out option for crypto scammers. More evidence that some crypto regulations just don't work. And as the interesting icing on top, newcomers to crypto seem to be on the lookout for scammers because a substantial increase in crypto prices doesn't result in an increase in scamming profits. Now, the authors then pivot to rug pulls and give a list of the largest ones of 2021. So, once again, I'll give you the top 3. Drumroll, please. A Turkish centralized exchange called Thodex, $2.6 billion. A decentralized autonomous organization called Anubis, $58 million. And a DeFi project called Uranium Finance, $50 million. Now, one of these rug pulls is not like the others, but it looks like Chainalysis has a fairly broad definition of what counts as a rug pull. I also have a feeling that there were way more rug pulls than Chainalysis identified, but that's a topic for another time. The 8th part of the Chainalysis report relates to terrorist financing, which is a favourite talking point for anti-crypto critics. I'll start with a somewhat comical quote from the first paragraph of this part. Quote, "We've identified a number of terrorist organizations that have attempted to finance their operations with cryptocurrency. What's harder to find, however, is a group that has gotten away with it. Case in point, it appears there was only one terrorist organization that raised funds using crypto in 2021. It only raised around $100,000, and this crypto was subsequently confiscated by the Israeli government when the terrorists tried to cash it out using a crypto to fiat gateway. Case closed. The ninth part of the Chainalysis report relates to darknet markets, and this is where things get a little scary. That's because the revenue brought in by darknet markets has been on a meteoric rise over the last decade, and last year was no exception. On the bright side, the total revenue brought in by darknet markets was a measly $2.1 billion, which is a drop in the bucket in the context of the broader financial system. Moreover, the number of darknet markets actually saw a sharp decline in 2021, which could be a sign that they're shutting down or a sign of consolidation in this niche. The authors seem to suspect the latter because they specify that most darknet marketplaces gave early notice that they were shutting down and even issued refunds to their users, something that's apparently very rare. The few darknet marketplaces that remain are apparently engaged in a sort of turf war, with administrators constantly launching cyber attacks on their competition. Let me just say that would make for a great movie. Now, Hydra was estimated to be the largest darknet marketplace, accounting for 80% of total revenue from a customer base that was already on the decline. I should also add that about a week ago, and after this report was released, the Hydra marketplace was taken down by law enforcement. RIP. You can find out more about that by watching yesterday's weekly crypto review, and that's in the description. Anywho, as the authors explain, the number of darknet marketplace users has fallen from 1.7 million to 1.2 million over the last 5 years or so, yet the profits of darknet marketplaces continue to climb. I guess inflation really is affecting criminals after all. On a more serious note, one possible explanation of this phenomenon is the uptick in direct transactions between darknet marketplace vendors and buyers, which has been on the rise since 2019. The authors speculate that this is because of the trust that has been built between select buyers and vendors over the years, which cuts out the need for a marketplace as the middleman. Once again, the lion's share of all crypto used for darknet marketplace purchases is cashed out using regulated centralized exchanges. And by this point, I think it's pretty clear that punishing regular crypto users with regulations is pointless. The authors then reiterate the trend they're seeing towards Monero as a preferred payment method, with the number of darknet marketplaces accepting the currency increasing from 45% to 67% over the last year. Now, this is not to say that privacy coins are inherently banned, and I would go as far as to argue that privacy is a prerequisite for financial freedom. You can learn more about that by watching my video about the worst case for cryptocurrency, which will of course be in the description. The 10th part of the Chainalysis report relates to high-risk jurisdictions and sanctions, something that's been in the headlines a lot lately. The first country the authors examine is North Korea, which is known for funding its state operations with proceeds from crypto crime. It looks like the Hermit Kingdom had a, quote, breakout year because it brought in no less than $400 million in 2021. The United Nations Security Council believes most of these funds have gone towards funding the country's weapons research and development. Yikes. If anyone's wondering, North Korean hackers appear to have an affinity for Ethereum, as it accounted for more than half of the funds they acquired through their illicit operations. This might have something to do with the fact that they're using DeFi protocols to launder their proceeds. They also seem to be a big fan of mixers, with almost 80% of stolen crypto being obfuscated in this manner. I suspect this is because it makes that crypto easier to cash out from a centralized exchange. Interestingly, North Korea seems to be sitting on almost $200 million of unmixed and unlaundered cryptocurrency, and it's been sitting on some of it for as long as 6 years. The authors say that this is evidence of careful planning by the North Korean government, but if you ask me, they lost the private keys to those wallets. The second country the authors examine is none other than Russia, and the authors commence with the only appropriate comment, and that's that Russia accounts, quote, for a disproportionate share of cryptocurrency-based crime. The authors ascribe this overrepresentation to robust computer education combined with a lack of economic opportunity within the country. As a result, Russian hackers, which Chainalysis calls, quote, some of the most skilled in the world, are the evil masterminds behind most of the ransomware that exists. It's also almost certain that Russians operated the aforementioned Hydra darknet marketplace. Chainalysis estimates that a staggering 74% of all ransomware revenue is affiliated with Russia in some way, though they do explain that Russia isn't the only country where people speak Russian. That said, Chainalysis also identified a series of crypto services operating out of Moscow that have received billions of dollars of crypto from wallets associated with illicit activity over the years. While the authors believe it's possible that some of these Moscow-based crypto services simply don't know they're dealing with dirty cryptocurrency due to the small amount of it they receive relative to their total volume, for others it's quite clear that they know exactly what they're doing. Now, the craziest part is that most of these shady Russian crypto services are operating out of the same building in downtown Moscow. It's not just any building either. It's called the Federation Tower, and the authors brand it as, quote, one of the most prestigious buildings in all of Russia. Now, when it comes to what's next for crypto crime in Russia, the authors aren't entirely sure, and I can certainly sympathize with this sentiment. There have been so many contradictory crypto headlines coming out of the country, with the central bank wanting a total ban and other government officials calling for full legalization. However, with the unprecedented sanctions Russia has faced in response to its invasion of Ukraine, I have a feeling they'll be keener to embrace cryptocurrency rather than eliminate it. If you're wondering how Russian sanctions could affect you and me, you can find out using the link in the description. Now, the third and final country the authors examine is Iran, which you'll recall seems to be playing a significant role in ransomware as well. Interestingly, most of the crypto money the country is making seems to be coming from Bitcoin mining, which has brought in around $200 million over the last 5 years. I must admit that I find this a bit strange, given that Iran is sitting on substantial oil reserves and sales of said oil is making it much more money than Bitcoin mining. If my calculations are correct, with the current price of oil, Iran is making the same amount of money in 2 days from selling oil as it has from Bitcoin mining over the course of half a decade. Never mind the fact that they've been turning off the Bitcoin mining machines lately, something the authors also note. What's crazy is that the authors explain that the way the current sanctions against Iran are written, it's technically possible for an individual or institution to be in violation of those sanctions if they submit a BTC transaction that's processed by a Bitcoin miner based in Iran because of the transaction fee. Let me just say that the absence of regulatory clarity in the crypto industry is very real. The authors then go over some on-chain evidence which suggests that Iran's mining revenue is actually much larger than 200 million, something that makes sense if the country is truly low on energy because of Bitcoin mining. That reminds me about all the environmental and energy use concerns around crypto mining that we keep hearing about and how they were thoroughly laid to rest by a recent report from CoinShares. More about that in the description. And now for the big question. What does all this mean for the crypto market? Well, I think the introduction to Chainalysis' report says it all. 0.15% of all crypto transactions are associated with illicit activity, which is magnitudes less than what we see in the global financial industry, despite all the strict rules and regulations it supposedly abides by. The downward trajectory in the frequency of illicit activity is also a big eye-opener, and I think it's a sign crypto criminals are starting to realize that blockchain analytics companies like Chainalysis can see almost everything they're doing. This explains stuff like the move away from illicit intermediaries like darknet marketplaces and the increasing popularity of privacy coins. Unfortunately, these new trends mean that privacy coins are likely to become a primary target for regulators around the world, and privacy itself could be at stake as regulators realize just how much information they can acquire from public cryptocurrency transactions. In sum, Chainalysis' findings and others like it are likely to make individuals and institutions feel more comfortable using cryptocurrency as time goes on, which you'll recall is Chainalysis' endgame. This will result in more direct and indirect investment into the industry. In short, numbers will go up. At the same time, however, we could see a call for unprecedented regulations, including KYC on every single cryptocurrency wallet, and even personal information embedded into every transaction, as some politicians have proposed. In short, financial freedom could disappear. Once it becomes clear that crypto crime isn't an issue, the next battlefield will be privacy. And that's a battle that the crypto industry must win at all costs, or else. And that's all for today's video about Chainalysis' Crypto Crime Report. If you found it informative, smash that like button to let me know. Be sure to subscribe to the channel before you go and ping that notification bell to make sure you don't miss the next video. If you're looking for more from the Coin Bureau, I have a second channel called Coin Bureau Clips, where you can see what I get up to off screen. The Coin Bureau podcast is also another place you can find me, and it's filled with valuable crypto knowledge that you need. I'm also active on Twitter, TikTok, and Instagram, and give you my current thoughts about the crypto market on Telegram. I even have a weekly newsletter where I talk about market trends that caught my eye, give you a detailed breakdown of my personal portfolio, and explain how it's changed and why. With the summer weather around the corner, consider getting something from the Coin Bureau merch store to stay crypto when the weather gets warmer. Last but not least, there's my deals page, which is where you'll find offers to put no coiners into a rage. You can find all these resources and more using the links down below. Thank you so much for watching, everyone. This video is officially done and I am off to get some sun. This is Guy bidding you goodbye.